Unsurprisingly, US tech stocks are continuing their pullback, and capital is frantically front-running the exits. With just one day left until Nvidia's ultimate earnings judgment, the market is clearly losing its nerve. Okay, look at last night's tape. S&P down, Nasdaq down, Dow down. It's obvious that capital is rotating heavily into defensive sectors. And before Kevin Warsh even officially takes office, the bond market just gave him a brutal wake-up call today. The 10-year Treasury yield smashed right through 4.6%, hitting a one-year high. The 30-year spiked to 5.30%, right back to subprime mortgage crisis levels. When bond yields sweep, tech stocks get crushed by valuation compression. Last night's landmine blew up in a storage sector first. One sentence from Seagate CEO at a JP Morgan conference directly triggered the market's nerves. He said, "We have no plans to expand manufacturing capacity, as building fats take time and risks overcapacity." The market translated this as, even though you are eating the AI dividend, if your deliveries can't keep up, hasn't your stock price run way too far ahead of the reality? That's why the entire storage sector puked last night. Okay, moving to gold. Yesterday's intraday bounce in a US session was purely a technical relief rally, absolutely not a trend reversal. Because right now, under the dual macro uncertainties of the Strait of Hormuz and energy prices, short-term capital is terrified to step into gold. And plus, with the crushing pressure of inflation, even the permeable mega institutions are capitulating. JP Morgan just aggressively slashed their 2026 average gold price target from 5,708 down to $5,243. Silver got it even worse, completely wiping out all of last week's gains. The previous narrative pricing and the physical shortage has been debunked. Current silver inventories are back to 2024 levels, and ETF holdings are dropping from the highs, and the bubble is actively being squeezed out. Finally, let's highlight crude oil. Headlines are still driving the tape. Trump originally announced a restart of operations against Iran, and oil reaped on Monday. And yesterday, he pulled a sudden flip-flop, delaying today's planned strike, and oil immediately dumped. But smart money quickly realized delay does not mean cancelled. So within 48 hours, global oil prices went through a brutal three-stage roller coaster: pump, dump, and bounce, with a massive 9% swing. But you need to pay attention to a dangerous signal. Oil sensitivity to headline is fading. A month ago, a geopolitical flip-flop of this magnitude would have triggered a way bigger swing. This tells us the market is getting desensitized to pure jawboning, and capital is hunting for a more definitive macro direction. And going forward, keep your eyes glued to whether Brent crude can hold above $112. That won't just dictate the life or death of the oil market. It directly locks in the script for global inflation. As always, this is just my personal trading analysis, not financial advice. And also shout out to EBC Financial Group for sponsoring the content.